than the one that worked the hardest. All you got to do is look around at all the hardworking broke people to realize that's not the solution. Buffett said risk comes from not knowing what you're doing, which kind of gets back to, remember the question somebody asked, is this riskier than this? Depends on what you know and how you put the trade together. Now, unfortunately for all of us, nobody becomes an expert on trading options in 2 days. This will be a fantastic start to the process, a better start than you could get anyplace else on the planet. Period. End of conversation. But I am hopeful that this represents kind of laying the foundation. And then over the next year, we work together to build, the infrastructure and put in the plumbing and the electrical and the roof. And then ultimately we decorate it. And that becomes the difference between knowing a little bit and knowing a lot. And when it comes to options, because we're dealing with something that is leveraged and that moves quickly in both directions, knowing a lot is super important. Okay, I want to talk to you about technical analysis. When people ask me what is the most important skill for an option trader, hands down, technical analysis, which surprises some people. They might think I'm going to say discipline or knowing all the right strategies. All that stuff is great. Obeying the rules, fabulous. But none of it matters if you can't look at a chart and have a pretty good idea of what a stock is likely to do next. Or, having said another way, how to pick stocks that are more predictable in terms of what's going to happen next. There's a lot of charts, and you'll see me do it. I'll do it with you. I'll look at them and I'll go, I have no idea what this stock's going to do next. So I don't take a trade on it. I wait until I find setups that indicate to me, hey, this is what's probably going to happen. Having said that, forecasting stock prices is a lot like forecasting the weather. Having the right tools and all that good stuff, but nobody gets it right 100% of the time. I don't watch local news for a whole variety of reasons, not the least of which is and I don't watch network news either. 95% of it is just negative, because that's how you get people to watch, right? Massive car crash on Main and 4th, details at 11, right? I don't know about you. I don't want to watch a massive car crash. I don't think that's good for me or my psyche. So I don't watch news, but I used to be in love with the Weather Channel. You know what I figured out about forecasting weather? They get it pretty good for the next few days. The further out they try to go, the less accurate they are. And if they go out beyond more than about 10 days, they might as well be using Iggy's Farmer's Almanac, for my friends that have ever watched Married with Children. It's a guess. What's the weather going to be next month? They don't know. Neither do I. If it's summer, it's going to be hot. But same thing with stocks. One of the things that cracks me up is when somebody will say, where do you think Apple's going to be in 6 months? I go, in business. That's all that I know. I don't know where they'll be in 6 months. Tell me what the economy does for the next 6 months, what the Fed does for the next 6 months, what unemployment does. Tell me what the sales are going to be on the iPhone 17. Then maybe I could take a guess. And by the way, one of the things that's really important to do in life is to know the things that you don't know and be okay with it. Because the things that I don't know about option trading, almost nobody does. So on technical analysis, we're trying to figure out, where do I think this is likely to go, and then be ready to pivot if we get it wrong. Doesn't mean we did anything wrong. The market is not always logical. I've seen companies that have announced earnings that beat revenues and beat earnings and the stock fell. I've seen that. Why? Because it didn't beat enough. And in fact, in the earnings game, there's what the analysts say, and then there's something called the whisper number. Ooh, what's a whisper number? It's kind of what people won't say they think is going to happen, but it's what they really think is going to happen, right? So all we need to be is right most of the time. And if you can get that, and you can, when you get good at technical analysis, it is a recipe for building wealth. Gretzky says, this is the only guy that got me to watch hockey. I don't understand hockey. When you watch it on TV, you can't see the puck anyway. It's just like watching dudes. But I watched him because I will watch excellence. I don't care if it's tiddlywinks. If you're the best in the world, I'll watch you. He says, I skate to where the puck is going to be, not to where it's been. That's technical analysis. Actually, with technical analysis, you don't skate to where it's been, but you pay attention to where it's been. Because a lot of times that'll tell you where that stock is going. So the whole idea of reading a chart, I was kind of a slow study on this. There were times when I would look at a chart and I thought, I don't even know why I'm looking at this. I don't know what I'm looking at. And I have found what was helpful for me. And, I get asked, what do you think makes you a good teacher? I've actually been asked to go teach teachers how to teach. And I said, because I'm not gifted. So what I have to do to learn something is break it down into smaller components that are consumable for me. So you'll notice that's the way that I teach. It's like building a Lego set, which I don't know how to do, right? But it's just block by block. So that's the way we're going to approach technical analysis. Most people think, man, when I get taught, I want to get taught by a genius. No, you don't. They'll talk a language you don't understand. You want to get taught by an average person that's really studied something and that has the ability to share it with you. So here's where we need to begin. What is it that moves the price of a stock? Now, when I would do classes in person, right, I would just ask the group and people would raise their hands. I would say, what makes the price of a stock go up? Earnings, revenues, management, innovation, right? All that stuff. No, 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 and no. Do you want to know what makes the price of a stock go up? People buying the stock. What makes the price of a stock go down? People selling a stock. So I refer to this as buying pressure and selling pressure. You're like, okay, I buy that. And then if I were to say to you, so explain to me why that's true, you'd go, I don't really know. It just made sense. So let me go to the next step. In the financial markets, we have middlemen, floor traders, market makers. On the New York Stock Exchange, we have specialists. How do they make their money? Not commissions, not based on the direction of the stocks. How do they make their money? On the spread. Okay. So let's keep that in mind. In their perfect world, they have exactly the same number of people who want to buy a stock and sell a stock, and then they would just cross the trades and make their little piece. Well, they will tell you that life doesn't work out that way. So here's what will happen. Let's say we're on I hate this term, a hot stock. I hate it because of all the time somebody said, hey, man, can you give me the name of a hot stock? Right? Yeah, Sun Industries, that's a hot one. On a stock that's in heavy demand, what the middleman wants to do is call him a market maker. What the market maker wants to do is they want to slow down demand and they want to incentivize selling. That's what they want. They need fewer buyers and more sellers. So how do you create that dynamic? You raise the price of the stock. See, there's X number of people that'll buy the stock at 100. There's fewer people that'll buy the stock at 110. fewer yet at 120. Now, in the beginning, buying begets buying, right? Oh, that stock's going up. I'm going to get in. Fear of missing out. But then as the price goes up, then you got people who own that stock going, yeah, I don't think it can go up much higher. I'm going to start selling here and take profits. You heard the term profit taking? That's what they're doing. So what happens is the buyers are here and the sellers are here. And then as the price goes up, it starts to go like this, not necessarily that orderly. And then ultimately they overshoot. Then the stock starts coming down, right? Until it hits a point where the buyers start entering back into the picture because it looks like such a good deal. So it's this going on all day long. All right. That's why you can look on a chart on anything. There, let me prove it to you. And again, I don't script any of this stuff out. Like NVIDIA. We all agree NVIDIA is a great company, been heavily in demand, has made a lot of people a lot of money, including, but does it go straight up? No. During this period, the buyers were in charge. Oh, then there's some profit taking, some indecision. Buyers are in charge. Profit taking. On maybe the greatest company on the planet, the stock went from 136 down to 100. Why? Because of this dynamic that is going on based on expectations. See, the buyers are buying because they think the price is going up. The sellers are selling because they think the price is going to go down. Who's going to be right? It'll be the majority. So technical analysis is really the study of investor behavior. Investors are either people or computers programmed by people. Hence, there is a definite emotional element to the analysis. And in fact, if you watch, most of you, I'm assuming, watch Charles Payne show, you will hear human characteristics ascribed to the market. And really what it is, that stock's getting a little tired. How does a stock get tired? Would you put it on a treadmill? Did you make it do push-ups? No, but we're relating back to how investors feel when they see something. So it's an exercise in both science and psychology. And you got to learn to kind of put all of those together. Now, mathematicians over the years have done their damnedest to try to quantify. People are starting to ask me now about artificial intelligence. Do you guys use artificial intelligence to pick your trades? No. Why not? Because it's not that simple. You've got to be able to get into the heads, and maybe one day artificial intelligence will be able to do it. And trust me, I get pitched every artificial intelligence platform that is out there. And a lot of them I've looked at, if the source was credible. I haven't seen any of them yet that can replicate what a person does. When Warren Buffett announces he's using artificial intelligence to pick his stocks, and Charles Payne announces he's using artificial intelligence, and Jamie Dimon and Bill Ackman are using artificial, and then I'll start to pay attention. None of them are. So, by the way, that's a warning to all of you, because you will start to see ads. Hey, this thing is picked, blah, blah, blah. And let me just tell you something. If I had a formula that picked 97% winners, I sure as hell wouldn't be selling it. I'd just be doing it. So, you find the people that are doing it with real money, like Charles, like myself. And then there's other people, they just sell tools. I've never had a problem selling knowledge, however. I think that is an honorable thing to do. Never had a problem selling relationships. Like, do I feel bad about the fact that, a kid spends $200,000 to go to Harvard? No. Do you know why? Because he or she in their lifetime will make $2 million more than somebody who didn't. That's okay. But all these widgets and get rich, be dubious, my friends, and ask yourself, if that thing really worked, why isn't Fidelity using it? The stuff I'm teaching that Charles teaches, Fidelity uses, Merrill Lynch uses, Charles uses, I use, right? So that's sort of the foundation for all this. But mathematicians down the years have created these indicators, and a lot of them have real validity, right? With results that can be replicated. And we're going to talk about the ones that are both user-friendly and that will add real value to your trading results. And then there are things called chart patterns. And chart patterns are really based on looking back in time at movement and behavior. And one might appropriately ask, what do I care what this stock did over the last 6 months? The answer is because other investors and traders care. Let me give you a dumbed down, simplified example. You're looking at a chart and you see a stock, and every time the stock hits 50, it goes up until it gets to 70 and it goes down. And it hits 50 and it goes up, and 70, it goes down, right? So you see this pattern. What's your strategy? I'm going to buy call options at 50. I'm going to sell them when it gets to 70, and I'm going to buy a put option, right? Until what? Until it doesn't work. Until it breaks below 50 or breaks above 70. The point is that you've got millions of investors, people like you and I, that are looking at these patterns going, hey, did you notice? And these things that are noticed then cause us to take a particular action, and our action is what moves the market. That's why I started with what makes a stock go up? Buyers. What makes a stock go down? Sellers. If there aren't any buyers or sellers, the stock doesn't move. I don't care what the business is doing. Hence, I want to be looking at the things, and you want to be looking at the things as causing somebody to either go, I'm in or I'm out. I'm buying or I'm selling. History does very often repeat itself. And a lot of times that repetition is based on nothing more than expectations. So we're going to be doing a deep dive into various indicators that Charles likes and that I like. Fortunately, we like the same ones. And by the way, it's the same ones that every successful trader is out there using. There's nothing really new under the sun. It's not that we don't look at other things or consider other things, but we stick with what's worked, But on all these indicators, I want you to know sort of where they're pulling from. All technical indicators are derived from the following pieces of data. The opening price. Opening price is the first published price of the day, right? When the market opens at 9:30, what does that print say? The closing price. Market closes 4 o'clock Eastern. What was that last price? We don't get into after hours trading on this. The high of the day. What was the highest level that stock achieved? The low of the day, the lowest price, and then volume. Right? The more volume, the more credibility that the move will have. So all these algorithms are using the same information. They're just using it in different ways. You could go into your refrigerator, take the ingredients that you've got, and make a hamburger, you take those same exact ingredients, I'm assuming, I don't cook, and make meatloaf, right? Meat and bread, right? So that's all that we're talking about. This is what's in the fridge that they have to pull from. Now, indicators are either going to be lagging or leading. So a lagging indicator tells us what's happened. Why do we care about what's happened? Well, because it tends to repeat. A leading indicator will be more predictive in nature, but there's no such thing as a crystal ball. If there was, everybody would be using it. But you can definitely improve your odds. By the way, those of you that have taken an Economics 101 class, I'm going to give you an example of a leading economic indicator, and that's the stock market. This is important because the market is always looking forward. The market is always asking, again, I'm giving it a human characteristics. What do I think is getting ready to happen? For example, in 2020, COVID hit, right? Tons of uncertainty, market falls, lots of volatility. Then what happened? Government went to the printing press. Government basically said, people of America, we're not going to let you fall. Businesses of America, we're not going to let you fall. We're going to give you money. Where's it going to come from? The printing press. We'll just go further in debt as a nation. Whether that's good or bad, that's not the conversation. This is what Wall Street was seeing. So Wall Street sits back and goes, holy cow, they're going to print all this money. That's going to be good for business, and it's going to be good for the stock market. Let's go in and buy. And in 2020, the market, with a lot of volatility, it should have crashed, but it didn't. 2021, all of a sudden we started hearing about inflation. And the Fed steps in and says, hey, inflation is hurting people at the lower end of the economic scale. True. By the way, is inflation good or bad? Depends if you got money. If you got money, inflation's great. Value of all of our assets are going up. You know, rich people are looking around going, I don't see what the problem is. Well, we know what the problem is. But for the people that are struggling, you know, you bump up the cost of their groceries and their medical care, and it's a disaster. So what the Fed does is they say, we need to slow down inflation. Their primary remedy for slowing down inflation is to raise interest rates. Interest rates going up is traditionally bad for stocks. So as they start raising rates, the stock market starts coming down. And it bottomed out in October of 2022 when the Fed stopped raising interest rates. And there was talk that at some point, as inflation continues to move down, that the Fed might in the future cut rates. So the market starts going up before there was ever a rate cut. The first rate cut just happened. First rate cut in 4 years happened Wednesday. But the market's been moving up in anticipation. You follow? So the market is always looking forward. Okay, I said the stock market is the leading economic indicator. What does that mean? It means before the economy improves, the market will go higher because the market knows, based on history, what the government is going to do. If we're in economically slow times, the government's not going to let it stay that way. Among other things, what is the job of government? The true job? To get reelected. How do most people vote? They vote with their wallets. Yeah, you may think that's good or bad. It doesn't matter. It's just reality, right? So there's a direct correlation to elections and how the economy is doing. So what Wall Street knows is if the economy is slow, then we're going to ease lending standards. We're going to pump money into the economy. We're probably going to lower interest rates, and all that will ultimately be good for the market. So stocks go up in advance, in anticipation of the market getting better due to these financial policies. So as an investor, that's why I told you yesterday, you got to know what's going on around you to get an edge on the market. If I were to, and I went through kind of all the fundamentals yesterday morning with you. Prior to that, if I'd have said, tell me what you think the market's going to be doing for the rest of the year and tell me why, most of you would have said, I don't know. And I don't know why I don't know, right? But now after a little bit of education, you're starting to be able to put the pieces of the puzzle together. Hey, this is an election year, and the Fed did cut, and earnings are forecasted to grow. Now, historically, September's the worst month. October has the most volatility, and November, December, and January are generally good. So you would say, hey, I think, and now you would have a basis for it. But if you're not informed or educated, you know what you're doing every day of your life? You are guessing. And most guesses are based on what? Feelings. You want to know what the problem with feelings? We're all fickle. Your feeling is going to be influenced on how much sleep you got, how you're getting along with your significant other, what you have to look forward to in your day, how things are going at work, how your kids treat you, right? But that's the way most people invest. That's why the average person underperforms the market. So understanding the market is a leading economic indicator. It is always looking forward, and that's why we want to be looking at both history and trying to forecast future, because the future is where your profits or loss will be. These indicators that we're going to be talking about, they serve one of three purposes: either to alert, to confirm, or to predict. So to me, an alert's kind of like hey, something might be happening. Now, you don't act on that. You want to get confirmation on that, which would then allow you to predict what is likely to happen in the future. Kind of the analogy that I use. When I first started traveling, if there was a smoke alarm that went off, I assumed that meant hotel on fire, get out of there. And I've probably had 25 fire alarms go off in hotels in my life. Not one of them was a fire. Doesn't mean I don't pay attention, but it means a fire alarm is an alert. If I were to smell smoke, actually the first thing I do is I call the front desk. Hey, do we have a fire? Nah, some kids pulled the fire alarm. Okay, it'll be off in a minute. Great, right? But I look for confirmation. Now, if I smelled smoke, there's my confirmation. And if I see everybody running in one direction, I can assume and predict they're running away from the fire toward safety. When it comes to reading charts, we want all of the indicators to be lined up. In other words, if the overall market is bullish and we're looking at a bullish sector, and then we go find a bullish stock within that bullish sector, on that stock, we will take a bullish trade and have a high probability of making money. Now, if the overall market is bearish and we're putting on a bullish trade, chances for success have just dropped dramatically. So we're going to be talking about what things are we looking at to identify trends, patterns, and how do we use these indicators? So the chart that we will be using, and I'm going to be toggling back and forth, the chart will be what's called a candlestick chart, okay? And we can use NVIDIA since it's up here. So each one of these little things we refer to as candles. Some look more like candles than others. But to be effective utilizing this type of a chart, you need to understand it. So that's where we're going to begin. Okay. And I'll move between the chart and this slide here for a little bit. So the first thing you may notice is that on this chart, the candle's either green or red, right? Okay. So a common misconception is a green candle means that we had an up day, and a red candle means we had a down day. That is true most of the time, but not always. So what does a green candle mean? It means the closing price of the stock was higher than the opening price of the stock. Well, then it was an up day. Not necessarily. I don't get what you mean. On Monday, stock closed at 100. On Tuesday, it opened at 97 and it closed at 99. Candle would be green, even though on Monday the stock was at 100 and on Tuesday it closed at 99 and it was actually down $1 a day. So this tells us what happened intraday. It doesn't compare it to the previous day's close. A red candle means that the closing price was lower than the opening price, but it still could have been an up day, meaning stock closed at 100 on Monday. Tuesday, it opened at 105, closed at 103. Yep, $3, but the candle would what? Be red. So let's look at the parts of the candle. We'll do the green one here. And whether it's green or red, the solid portion is known as the body. And just like with us people, bodies come in all shapes and sizes, right? Here we got this tall body, right? Over here we got this little short body. So what is the significance? So one of the things that I do when I'm looking at a chart is I take note of what are the size of the candles. The bigger the candles, that means the bigger the intraday difference between the opening and the closing. It's another way of considering volatility. So as I look at NVIDIA, it's kind of a mix. Got some big moves and it's got some little moves, right? Others, you'll see nothing but big moves, not nothing but you'll see one dominated by big moves or some that barely move at all. That's helpful for us to know as traders. What can we expect? So a big move just indicates more. Now, see this one right here? Basically what happened is the opening and the closing price were about the same. And you can look on here, the open was 103.84. The close was 104.25. The difference is about 40 cents. Not much of anything, especially for a $100 stock. Over here, the open was 92.06. The close was 145. Difference between the opening and the closing, big. But I already knew that by looking at the size of the candle. Same thing here. Open 107. Or excuse me. Yeah, the open was 107. The close was 98. Thing almost dropped $10. So when I'm looking at a chart and I see a lot of long candles, I need to be prepared for the fact that this would be a stock that could make big moves. Good news is if I get it right, if I did a call option, I got a big move. Hey, that's fantastic. Get it wrong, just know that you would lose quickly on that. This thing sticking out the top right here, that is known as the wick. Notice, just like with the bodies, look at that tall wick. And this one had no wick at all. What's the difference between that move and this move? Well, if we're at a green candle and there's no wick, it tells me that this closed at the high of the day. So let's look. The high was 95.40. Where did it close? 95.39. Close enough, off by a penny. Hence, no wick. Over here, I see a long wick. The high was 106.32. The close was 103.80. So it tells me as a trader, the stock got to 106.32, and then people started selling and drove the price down to 103.80. Okay. A long wick, even though it didn't happen here, is generally considered bearish. Like here, look at this long wick. Stock got up to 130, closed at 126, and then it gapped down the next day and closed way down here and actually closed at the very bottom, which would typically be bearish, but it's NVIDIA. It came roaring back. But for your notes, a long wick, and we don't make a decision on any one of these elements. I'm putting the whole picture together. A long wick means the stock went up and got sold off before the market closed that day. Generally bearish. Now, the other side, see this thing sticking out the bottom? We call that a tail. By the way, some people refer to this and this as the shadow. I just don't see the logic in it, so I don't use that term, but you may hear it. To me, it's a candlestick. That's a wick. This is a tail. So when you get long tails, what does that mean? The stock, like here, fell to 117 and it closed at 121. So when it got to this level on that day, the buyer said, I think it should be more expensive, and bought it up all the way to here. So it's the opposite. A long tail, here's another long tail, is generally bullish. So if we find these long tails, we'll normally see for some period it go up. Then look what happened. Like right here, that is bearish. A long tail, that one's not particularly long. Oh, what about this? Look at that cross. It's not a religious symbol. That means that the stock opened and closed at the same price. That is a point of indecision. We call that a doji. Here's another example. You know, the stock got up to almost 120, closed at 117, and then the next day closed at 116. So there's a whole lot to be gleaned. There's another indecision point right there. And then notice the next day the stock went down. Indecision on NVIDIA means, hey, not everybody's in love. That's what it means. Okay. So, quick little summary. Green, close at a higher price than where it opened. Red, close at a lower price. We call the solid portion the body. Things sticking out the top, we call that the wick. Things sticking out the bottom, we call it the tail. Long wick, everything else being equal, means on that day, that's bearish. A long tail is bullish. Price got down, and then it was bought up before the end of the trading day. Okay. I think I'm going to save this for after break. Why don't we go ahead and take a 15-minute break at this point, and then we'll just continue moving ahead in our discussion on technical analysis. One of my favorite things to teach. Pretty fascinating stuff, isn't it? And there's a whole lot to it. So, okay, I will see you back here in 15 minutes. Thanks for being here. Okay, continuing on. Again, hold questions until we call for them, if you would. I'm going to get all the way through the technical analysis. And I promise you, uh, most of the questions you would ask anyway are just naturally going to get addressed. But if not, I'll be answering them. I have an itchy nose. So we're going to talk about trends. We've all heard the trend is our friend, right? But that's only true if you know how to determine a trend. So there are basically three trends. None of these, I think, will come as a big shock. Bullish means prices are going higher. Bearish, prices are going lower. And sideways. So when we talk about trends, I always like to start with the trend of the overall market. And what exactly is that? So let's talk about how we determine the trend of the overall market. So of all the indexes to use, by far the one that has the most validity would be the S&P 500. So for this, you can either use the SPY or you can use the SPX. I use the SPX just because it gives me the actual number. The SPY is 1/10. So how do we determine trend? This is a 6-month chart that you're looking at. So one of the things you could do is say, okay, well, where was the S&P 500 6 months ago? It was at 52.34. Where is it now? 57.02. Okay, so it's higher, hence bullish. All right, that'd be kind of the crudest way to do it. The next way, I pointed this out yesterday, is to look at this yellow line, which is a 50-day moving average. And we would basically look at two things. One, what is the slope of this yellow line? And it is slightly upwards, not pronounced like here, is definitely upward. And it kind of rolled over, but it is still slightly higher. So we would say very subtly bullish. And then we look at, well, where is the price of the stock in relationship to that line? It is well above. That is strongly bullish. So the slope, slightly bullish, well above, strongly bullish. So overall, based on that analysis, I would say overall bullish. Now, the proper way to establish a trend is to connect low levels and high levels. And let me show you how to do this. So if I were to look, and there are a bunch of different trends that you'll see for this 6 months. So I'm just going to, so if I connected the lows here, that's what it looks like. And I connected the highs here. That's what it looks like. Okay. So that was a trend, right? That would have been a bearish trend. And then I want you to notice something that happened. Right here, we broke above. So we call this an upper trend line and a lower trend line. So we're in a bearish trend. And then we break above this upper trend line. That is an indication that, hey, this trend may be changing. And it did. Now, all of a sudden, it became bullish. And we created a new trend line. So I'm connecting lows. You need two or more of them. Okay. So here, here, here. And then I'm going to connect the highs. So the market went from bearish, remember this is the SPY, to it broke above the upper trend line, turned bullish. We got further confirmation of bullishness when it crossed above its 50-day moving average, and it moved up, up, up. And what happened right here? It crossed below the lower trend line. We've had another change. I'm telling you what I'm doing right now. You got to practice this. It is an unbelievably important skill set, knowing how to draw these trend lines. Okay. So now now notice we crossed above here very temporarily, and then we fell back below. Then the real cross happened right here. We crossed back up above. Oh, good. Here comes a new trend. Okay. And then what happened here? I won't draw both sides. It crossed below. Okay. There's another trend. Now we got to do both sides so we can see where it made the next cross. So right here, it crossed above both the trend line and it crossed above the 50-day moving average. And it was bullish again. So where are we trend-wise now on the overall market? We're bullish at the moment. Look. Connecting the lows, connecting the highs. How long will we stay bullish? Until it crosses below the lower trend line again. Isn't that interesting? So I want you to, and I'll do this on another stock here in a second, but I want you to put something into your notes. You ready? Trade the breaks. You notice that when we get a break in the trend, then it runs for a while in that direction. Do you know why it happens? Because investors expect it to happen. Let's pick a different one. Do the same thing. Let's see if it works again. So here is Meta. And let's do the lower trend line. Notice the upper trend line here. That is an upper trend line. Do you notice what that forms? It forms a wedge, okay? And you're going to learn that a wedge is known as a breakout pattern and normally precedes a big move. Did we get it? Oh, yeah. Look at that. Now, this wasn't necessarily caused by the wedge. This was an earnings announcement. So then we started a new trend. So let's connect the lows. And we'll connect the highs. And then what happened here? We broke below. Okay, we're starting a new trend. So hopefully what you're noticing is that determining the trend, it's not guesswork. It's just taking the time to draw your trend lines. And then what happened here? It broke above, right? It broke above, then it broke below, then it broke above, and it was above the 50-day. And since then, it's taken off. I'll do it one more time. You're going to want to practice this. What do we want to do? Let's do Coca-Cola. This one's simple, right? But it's a great illustration. Look, There's your lower trend line. Boom. Here's your upper trend line. Let's just start from right here. Boom. What is the trend? Higher. What did I say about this stock yesterday when I pulled it up? Perfect for doing a covered call. Just kind of meandering higher. So when would we consider that this broke trend? When it either crosses, well, across, above, or below a 50-day moving average is pretty significant. We'll click through a few, but if it crossed below the 50 or it crosses below that lower trend line. Let me just show you something, the power of that 50-day. And again, I don't have anything preloaded in here. Let's see what percentage of the time, and it'll just be a general observation, when we're trading above the 50 that the stock goes higher, that when we're trading below the stock goes lower. Okay. What is this? This is Ally. Crossed above. Did it go higher? Yeah. Crossed below. Did it go lower for a period? Yeah. Crossed above. So while it's above the 50, it's going higher. Now, this case, it didn't. It went below the 50 and then it came right back. But look, boom, then it dropped. So is there validity in watching where we are relative to the 50-day? Hell yes. Those aren't stocks. Those are all indexes. Let's go back to Meta. When it's above the 50, here and here, did it trend higher? Yes. In this case, when it was below the 50, it didn't trend lower, but there are extenuating circumstances. What caused it to fall below the 50? An earnings announcement. So then you kind of starting from scratch again. Apple, when it's above the 50, going up, cross below, came right back, but it spent most of its time above the 50 and going up. How about Broadcom? Where has it spent most of its time? Above the 50 and going higher. But when it dropped below the 50, look at, and then it regrouped and came back, dropped below the 50. So these crosses above and below this 50-day are very significant. I would say that almost every case, when it crosses above the 50, you could have bought a call option and made money. Now, not necessarily long term, but it went from 133 to 139, bounced off the 50, went up to 180. You'd have made from 130 to 180, it's probably a 500 or 600% rate of return. Now, here's an example of where it wouldn't have worked. It just kind of went sideways. Crossed above here at 158. Now it's at 171. Here's a lesser known. Crossed above here at 291. Got up to 371. So we pay a lot of, here's NVIDIA. So NVIDIA right now, at the moment, doesn't look great. It crossed above here, 82, went all the way up to 124, formed a double top, fell below. This is a rounded top. Rounded tops are bearish and crossed below. So even though it's NVIDIA, there was a good chance this was going lower, but then it formed a rounded bottom, which is bullish, but then it ran up against this 50-day. And many times this moving average will act as a level of support or resistance. And right now it's kind of trapped up against it. Now I'm kind of waiting to see which direction it's going to break. There's no real level of predictability. Okay, so with trends, number one, there's only 3 of them. And by the way, the good news is there are strategies for all the different trends. I got 4 or 5 bullish strategies, 4 or 5 bearish strategies, 4 or 5 neutral strategies. But you got to know what the trend is. And you want to start with the market, consider the sector, right? Go to bar charts for that. And then the individual stocks within those sectors. And when I get into looking for potential trading opportunities, which I'm going to do with you, you'll kind of watch me step through that. But learning how to draw upper and lower trend lines is really important. And let me say this. When you are drawing these trend lines, if you want to do them precisely, remember, we're working off of the closing price. So if it's a red candle, it's the bottom of a candle. If it's a green candle, it's the top of the candle, okay, when you're drawing your lines. Now, in reality, does it have to be that precise? Not really. You know, I'm just drawing it to kind of get into the ballpark, but crosses above an upper trend line are bullish, cross below a lower trend line is bearish. They are highly reliable, albeit not absolute every time, but it will give you a huge advantage over people who aren't doing this. So some of you are option traders. Again, I'm not looking for you to type a response, but I wonder how many of you are trading options and take the time to draw trend lines and to see where the breaks are happening. And if not, you're at a huge disadvantage to me. I don't want you to be at a disadvantage. You're in this class so that every skill set that I'm using, you're able to use. And the reason why I use them, because they work. They give us an edge. All you got to know is a little more than the average person, and you can do a lot better than the average person. Okay. Again, I'm not answering questions until I get to where I'm answering questions. So just hold them. So again, just generally connecting two or more highs, two or more lows. Now, let me say something. The more times it touches that trend line, the more validity there is to the trend. The stronger the trend is, the more reliable that pattern is. That's a bullish trend. Higher highs on the top and higher lows. Nothing goes straight up. They're all going to go up and down. But when it goes down, does it go down not as far as the previous drop? Then you're bullish. So this is what bearish looks like. And what happened right here? We broke through that upper trend line, started a new trend. And this is a sideways trend. Now, what you're looking at is a fairly typical pattern, right? What we've got is a stock that was trending up, and then it just moves in a sideways. We call it a consolidation pattern. Kind of now the buyers and the sellers in this tug of war are in an equal battle. And when this is happening, most of the time, whatever was going on here will happen on the other side of this, as it did here. But you know what? I don't make the trade until I see a break. And here we got the break, and then you could have put on a bullish trade, like buying a call option. Okay. Trends, unbelievably important. So related to trends is the notion of support and resistance, in that we are going to be once again drawing some lines. I've told people that I could trade with nothing but support and resistance levels and do just fine. Now, the more things we have at our disposal, the better. But so support and resistance, I want you to think of them as kind of a floor and a ceiling. And there will be multiple points, usually on a 6-month chart, of support and resistance. So let me give you all the different points here. So again, when you're going to draw this line, I'm going to the top of this green can. I could have drawn it up here, but that's not where it closed. It closed down there. So I'm going to go right here. Hey, this thing's making me look bad in front of my friends. There you go. So a couple of things I want you to notice. You're like, well, wait, it went above that. Yeah, but it didn't close there. It closed down here. So we've had 2 touches on that resistance level. So this is our ceiling. However, we've had other levels of resistance after this, like right there. And since that point, right here, right? Now, I want you to notice something. This level that is now current resistance over here, it was support. Here it bounced off, right? And went higher. So one of the things that you will learn is that if we break below support, then old support then many times becomes new resistance. So it dropped below that level, and then it came up and it hit it, and it said, not so fast. Then it broke above, okay? Broke below. So right now, the latest and greatest, that is support, or excuse me, that is resistance, which is at 120. Right now, the stock's at 116. And support is down here at about 100. So I've got a lot more room to go down than I have to go up at the moment. And for me to get bullish and put a new bullish trade on NVIDIA, I need to see this stock go above 120. But then I'm going to be watching it really carefully, because last time it got up to 130, it fell. So I'd be making a bet that it would go up to 130. And then as it approaches 130, I'm watching this thing like a hawk. If it breaks above that, then I'm going to see, can it get above 136? If it gets above that, it's gone. It'll fly at that point. So it's like breaking through these ceilings to get higher, breaking below these floors to go lower. And it generally might take a couple of times to do it. And keep in mind and put in your notes, when we break above a level of resistance, then I go looking for the next level. So like right here, if it breaks above that resistance, then I'm going to look for the next level, which is at 130. And then ultimately it's at about 140. Okay. Because I know it's going to take effort. Now, let me tell you a very common mistake. If you're wondering, well, why do you care about where resistance is, as an example? Okay. So what if this stock had been moving up, breaks above the 50-day, right? Let's say that resistance is 140, stock's at 138. And then you go put on a bullish trade, stock goes up a couple points and then falls. You'd be like, I don't understand why I lost money. You lost money because you put on a bullish trade right underneath a resistance level. And or the reverse is true. If you put on a bearish trade right above a support level, support means we expect the stock to bounce. And I watch people do this all the time. You know why? They haven't been trained. So they're like, oh, yeah, this stock is bullish. And I go, yeah, you're right. But you see that it's kind of like, have you ever seen these people that apparently never went to driving school and they accelerate into a stop sign, or the light's red and they're not slowing down? And then they have to abruptly get on their brakes. What's worse than seeing it is being in a car when it's happening. It's like, dude, you saw the light was red. Take your foot off the accelerator. That's what we want to do in our trading. If I see a stop sign right in front of me, I'm not stepping on the gas and putting on a bullish trade at that point. I'm going to wait till we get beyond the stop sign. Then I'll start to accelerate. Let's do this on a couple of more. Here's Meta. Oh, so here's what's in now. Here's one of those little fine points. Okay. So generally what I do, if I'm looking for potential levels of support and resistance, is I go to the closing price of the stock currently, and then I go, okay, where's resistance? There isn't any. And then I go, okay, well, this is a 6-month chart. Then I'll generally go out a year. Okay, there's still no resistance. So this stock is at an all-time high, and it's moving higher, and there's no resistance in front of us. And I have a bullish spread on this right now, and I'm doing covered calls on it right now, all based on what you're seeing on this chart. Where was resistance? It was right there at 540, and it broke through it. Since then, it's run 21 points. Where is support? This is now support because it's broken through. So if this stock turned around and started coming down, I would expect that when it got back around 540, that it would bounce and go higher. It's kind of fun, isn't it? We're going to be doing this on some of your stocks later. Apple. Where's resistance? So first thing I normally do is I go, okay, where are we now? Okay. So then I draw a line at the last close. I go, wow, there's a lot of resistance here. Went a little higher here. There's resistance here. There's a whole lot of resistance at about where this stock is right now. And I'm going to consider my support to be this 50-day moving average. You know what I'm going to do with Apple at the moment? Nothing. Because I'm looking and the ceiling is right here, right? It's just above my head and support's right here. So you know what I'm going to wait for? A break, either above or below. And if I'm going to draw the lower trend line, it looks like that. A bit of a wedge, which could be a potential breakout. So think floor and ceiling, and then just kind of think of a ball in a room that has no gravity, and you throw it, and when it hits the floor, it bounces, hits the ceiling, it comes down, hits the floor, it bounces. Now, if I take my superhuman strength, which is a true thing, and I throw it and it breaks above the ceiling, it's going to continue going up till it hits the ceiling on the floor above me. And then it's going to come down until it hits this ceiling, which is no longer a ceiling for the ball, it's the floor. Right? If I use my superhuman strength and I threw the ball through this floor, it's going to go down to the next level. I'm on the 3rd floor of my home, and it'll go down to the 2nd floor, and it'll bounce, it'll try to come up, but then when it comes up against this floor, right, this is now going to be at ceiling. So it's like floor, ceiling, floor, ceiling, floor, ceiling. Does it work out that way exactly every time? No, but it'll get you in the ballpark. So like my favorite trades, if I'm in a bullish market, the lowest risk trade I can find is the stock bouncing off of a floor that doesn't have resistance right next to it. If I'm in a bearish market, my favorite trade is a stock that moved up, hit a ceiling, and it started coming down. Those, my friends, are high probability trades. And that's where you will, from time to time, capture those returns of 100, 200, 300%. I remember a bounce off of ExxonMobil that turned into 703%, right? Following exactly what I'm teaching you. I did in my last place, I've never had a man cave. Some would argue because I've never really been a man, but we don't list those people. I never had a man cave. So I thought, I'm going to do a man cave. Now, I don't need a man cave. So when I'm looking at things that I don't need, then I go to, okay, how many trades is it going to take for me to go make enough money to go, deck this thing out the way that I want it? Turned out it was one. It was a call option on Lamb Research that was bouncing off of a support level at that time. So it was funny. I had gone down. Remember I told you about visualizing? For some of you, you're like, hey, I understand. Others of you think this is all voodoo. Okay. So what I do is I went down to Best Buy, said, hey, how do you do a man cave? Oh, you're going to need this and surround sound and this 85-inch, and you're going to want a couple of these. Okay, price it all out for me. 3 weeks later, I walked in, I go, okay, let's go do it. All paid for out of one trade. Visualize. So I kind of make a big deal out of it. All right, let's talk about some chart patterns. And a lot of this I've already taught you. So chart patterns can be divided into 3 categories. Continuation, right? Trend is your friend. Breakout, which I've shown you already, and reversal patterns. And they all kind of tie in to what we have already done. So that's the good news. So continuation patterns, when you look at these 3 charts and you consider the trend lines in each, what can we say about the relationship between the 2 trend lines? They are running parallel to each other. And it makes me think of a train track. Trains going down a track have a lot of momentum. Hard to stop, hard to turn. So in this case, when I see this pattern, I'm going to bet that this stock's going to continue to move up. Kind of looks like the Coke chart, does it not? So I'm just going to keep betting on bullish trades, getting in down at the bottom and expecting to close out up near the top of that upper trend line. Over here, bearish trades. Now, in this case, taking bullish trade, bullish trade, bullish trade. When would I stop taking bullish trades? Breaks below the lower trend line. Bearish trades, bearish trades, bearish trades. When do I stop taking bearish trades? Breaks above the upper trend line. In a sideways, these are fun because there's 2 ways they can break. So right now we would be neutral, great for covered calls and spread trades, which you'll learn about. Breaks above the upper trend line. Now this becomes the level of support. That stock is going higher and now becomes bullish. We're going sideways, breaks below the floor. Now the floor becomes the ceiling. This stock's going down. Now we're bearish. How important is it to be able to recognize these things, to be able to forecast what that stock is likely to do in the future? It's the difference between making a fortune and losing your money. That's how important it is. Okay. This is a breakout pattern. Notice the upper and the lower trend lines are converging, that this volatility is getting tighter and tighter, and it's almost like you're pulling a rubber band, and at some point it's going to snap. I've never seen a stock move like this and then go sideways for any amount of time, right? It is definitely going to make a break. So what do we do when we getting a little encroached on by the sun here? You know what I've discovered? Now you can write this down if you want. I've learned from doing these, the sun moves during the day. That's right. In my case, goes from here to here. So I put the blinds down here and then the sun goes over here. Anyway, no extra charge for that one. So when I see a wedge form, I just make a note. So I always have notes going on, right? Right. Just you can see how fancy it is. It's on lined paper. You got to pay extra for that. And I just make a note, keep an eye on this. Means, come back every couple of days and look and see if you get a breakout to the upside of the downside. And if you do, there's a chance this thing's getting ready to run. Now I'm going to look at all of the other factors. If it breaks above, where's resistance, yada, yada. But it's a nice signal for me and for you. And reversal patterns. Another one of my favorites. Okay. So this level up here, that upper trend line. Okay. So this is known as a double top. It's technically, I guess it's a triple because it hit here, hit here, hit here. And basically what this chart is saying to me is when we get to about 60, the sellers are going to step in. They're going to start driving the prices lower. I want you to make note of this pattern right here. That's like a little mini double top. What does that letter look like to you? The letter M? Yeah. For your notes, write this down. M stands for murder. I know, dramatic, right? M stands for murder. If you watch Charles' show, he will point out double tops a lot. Do you know why? Because they are so predictive. You get a double top, this thing is going down. Now, let's focus on this M. Where you get real confirmation is when it drops below that middle part right here. So it comes up, dips, comes up, starts dropping, goes below that middle part, we're going down for some period of time. Then this became the support level. So when it went up and touched and broke that support, then it went into free fall. There's so much money to be made when you find patterns like that. And the risk, it's not a riskless trade because markets sometimes are irrational, but we've minimized the risk. And here's the chance to make several 100% on a trade. So kind of the reverse of that would be a double bottom. So here's what happens on this stock. It hit here, 33 and bounced. And then it hit here, 33 again and bounced. By the way, what letter do you see here? The letter W for your notes. W stands for winner. W stands for winner. Now, there were so many different signals, breakout signals on this particular chart. Let me go through them for you. And I've talked about all of them. Hopefully you're picking them up. So the first one is, here's this upper trend line, right? That got broken. That's bullish. By the way, down here, see that? If you have a question, hold it until I call for it. In any event, so down here, we had another little W. It went above that middle part of the W. So there was kind of your first, hey, something good could be happening. Then it broke above the upper trend line. Hey, we're bullish. And then it broke above the middle part, right? It 3 times this chart said this stock's going higher. But if you don't draw upper trend lines, you wouldn't have seen it. If you didn't know about double bottoms, you wouldn't have seen it. And if you didn't know about the middle part on the W, you wouldn't have seen it. So the fact that it went higher wouldn't have registered to you until the stock goes up. Finally, you see it. And then you're not aware that it's bumping up against a resistance level. Finally, you jump in and manage to lose money on a no-brainer. No more. Because now you know better. Is this cool? Do you know what a small percentage of people who know this stuff? The advantage that it gives us, sometimes it almost feels unfair. You will see setups. Now, this might lead to another question, so I'll preempt it. When we see a perfect setup, right? Might that influence how much we put into a trade? Yes, for sure. So, I have trades that, I like that trade. And, so let's say I'm doing 10,000 a trade. Something I really like, I might go 20, 30, 40, 50,000. Never go more than 10% of your account. Because again, nothing is for sure, but will I give more weight to certain setups than others? Absolutely, I will. And that's fairly subjective. All right, let's do a pop quiz at this point, cleanse the brain, make sure we're all still on the same page. What makes price of a stock go up? Buying pressure. Makes price of a stock go down? Selling pressure. What are the 3 possible trends? Bullish, bearish, sideways. What can those trends be ascribed to? Overall market, where we use an index. Could be a sector, could be an individual stock, could be an ETF. How do we find a trend? Well, we could look at the 50-day moving average and see what the slope is, and are we above or below? The technically correct way to do it is to create an upper and a lower trend line, and then to recognize that if a stock is going up, when it breaks below the lower trend line, you have a change in trend. If a stock is going down and it breaks above the upper trend line, you have a change in trend. And those are generally great opportunities for placing new trades and or getting out of a trade that you would be in. See, many of you asked me yesterday, kind of jumping the gun. So if you're in a call option, how do you know when to get out? And I said, when I'm no longer bullish. But we hadn't done this exercise yet. So what would cause me to no longer be bullish? Stock cross below lower trend line. Stock cross below the 50-day moving average. Right? So it wouldn't be a hunch. It wouldn't be a feeling. It would be what I see on the chart. When people ask me, what do you think about such and such stock? I go, what I think doesn't matter. Let's see what the market thinks. Let's go look at a chart. I could think the stock's great, but if it's being sold off, the fact that I think it's great, who cares? M stands for murder. W stands for winner. Those are double tops and double bottoms. Love this quote from Buffett. You can tell I'm kind of a fan of his. The market, like the Lord, helps those who help themselves. See, that's what you're doing, being here, helping yourself. But unlike the Lord, the market does not forgive those who know not what they do. You know what I've had to settle on? That is, the market doesn't give a damn about me. It doesn't care. Doesn't care that I'm a good guy. Doesn't care that I give money away, right? I'm a great grandpa, that I'm a really good dad. It doesn't care about any of that. Market basically is going to reward me or punish me based on what I know. Ditto for you. Let's take a 2-minute stretch. I want you to be fresh for this next segment. Just a quick 2-minute stretch break. Don't go anywhere. If you need to use the facilities, I'm going to go refill my water glass. 2 minutes. We'll rock and roll. Okay. Continuing our journey. Hope you all are taking really good notes. Taking it all in. If this is new to you, it should be pretty enlightening. I mean, you should be sitting there going, I had no idea. Now I get it why some people, are out there making 30, 40, 50% a year, and other people in the same market are losing money. One knows something, the other one doesn't know. You're going to be the person in the know, right? Okay. And by the way, I'll, for the 10th time, I'll be doing questions when I get to the end and I ask for questions. I always wonder, like, what is it that people hear when I say that? And then they're like, nah, but I got a question. I just think it's, studying human nature, I guess. All right. So now we're going to talk about indicators. That whole concept of alert, confirm, and predict. I really like indicators a lot. I've always said that technical analysis is a combination of art and science. Art is more of a visual thing. The art part is what we just discussed, recognizing these trends and support and resistance levels and drawing trend lines. And I'm not very artistic. That came more difficult for me. On the other hand, I can certainly tell if a stock is above or below moving average, right? So that's easy to quantify. And so I probably tend to prefer the indicators over the other. Plus, I get instant feedback with the indicators. But in truth, if you want to be professional about this, you got to do both. You got to be able to put them together. So let's jump into these. Some of our favorites, moving averages. Without a doubt, moving averages are the most watched of all of the indicators. So we'll be talking about those. The MACD, I'm sure you've heard all about the MACD. We'll be discussing that. High value that I ascribe to the MACD. The RSI, this is the relative strength index. I'm going to come back and give you an explanation of each. I use on a case-by-case basis. Sometimes the RSI gives me very little value. Other times, it's fantastic. I'll show you when. On balance volume, this is probably something that you've not heard of. I've never heard Charles use this term, and I'm not sure how I came across this. I don't know, maybe in one of the 200 books that I've read. But basically, it's a running total of volume. I will cover that. And then Bollinger Bands, you've heard of them, a lot of you. Some people make a big deal out of them. Candidly, I don't use them for a whole variety of reasons, but I want to at least, we'll have the conversation about them. Okay. So first thing I want to talk about are moving averages. Let's begin with, what is a moving average? It is the average closing price of a stock over some period of time. Probably the three most popular moving averages: 20-day, the 50-day, and the 200-day. Remember when we did the FinViz screener? It had the 20 and the 50 and the 200. So it says it keeps you on the right side of the trade. When you are above a moving average, that is considered bullish, below, bearish, for whatever this time frame is. So kind of what I showed you on the 50-day moving average, you could do for the 20, you could do for the 200. You know, what is the slope? Are we above or are we below? Then you could look at moving averages relative to one another. You know, in a bullish market, the 200 is above the 50, which is above the, so the 20 is above the 50, which is above the 200. When I was new to teaching, I kind of went through all of these, right? And then what I discovered is a couple of issues. Let me show you the first one. And I'll show you why I landed, kind of where I landed. So I've got the 50 up here. I'll explain why I use that. So if I were to put the 20-day on here, and then put the 200-day on here, oops. There you go. So now we got all three moving averages. And the problem is a lot of times they start getting close to each other. And it just, to me, and then what some people do, they have those, and here's why I don't use Bollinger Bands, then they'll add this, and that's what your chart looks like. Tell me what you see. And maybe my brain's different. I see a bowl of spaghetti. I don't know how to interpret that and turn it into a trade. You know, maybe you do. And if you do, God bless you. But I can look at that. I also tell you the reason that we use the 50. So a big part of technical analysis, it's all about investor behavior and the things. Remember I told you that we're looking at what other investors are looking at. The number one moving average being utilized is a 50-day. I remember one day I'm watching Charles' show, and from time to time, he will have, you know, a quote unquote chart lesson. So he brings in an expert in technical analysis, and they will talk about this and that, and they were talking about moving averages. And Charles says, yeah, I just look at the 50. And I thought, bless you, brother. That's exactly because that's what most investors are looking at. In other words, across above a 50 precipitates buying, across below precipitates selling. And do these other moving averages give me maybe a little more insight? I guess. But I always ask myself, is the juice worth the squeeze? Some things just aren't worth the extra energy and effort. I can get everything that I need personally out of the 50-day. So that's why I do it that way. So there you go. Now, you'll talk to other people that'll say, well, I use this and this and this. And these are also the people that got 3 monitors set up. And, okay, if it makes you feel good, great. I got 1 monitor, right? On my computer, I use 1 moving average and make a bunch of money. And that's good enough for me. So I'm always trying to be as practical as I can. And if there's a hard way to do something and a simpler way to do it, I'd rather share with you the simpler way because I know it's more likely that you'll actually do it. If I give you a bunch of stuff and you're sitting there going, hell, I'm never going to get this, well, what are you going to do? You're going to quit and you're not going to do it. But if I can kind of show you things and you're like, oh, I see it. I get it. Okay. A cross above that line is bullish. Okay. Cross below that line is bearish. So that's the way that I teach. And that's why I do it. I'm always looking for the practical. Now I've got a trading partner that will admonish me if my line on a green candle start. I'm like, does it make any difference in what our outlook is? Because I started at a millimeter. But she's got to be that's how her brain works. One's not better than the other. But again, my job is to consider who you are, where you are in your evolution. And as time goes on, because a lot of us are going to be working, together for the next year, we will get more and more sophisticated. But I think that there is a natural progression, which makes this easier. So that's what I try to do for you. Okay. So, like we said, above a moving average bullish, the 50-day below it is bearish. The MACD. MACD is kind of an interesting little critter. It's like the octopus. I'm convinced, by the way, that if there are aliens on Earth right now, it's the octopi. They've got 9 brains, 3 hearts, can change colors, can squirt. They're amazing. And I kind of compare the MACD to that. I think the MACD is super cool for a lot of reasons. First of all, what is it? It's a momentum indicator. How does it work? Basically, it compares a 12-day exponential moving average to a 26-day exponential moving average and a 9-day trigger line. And you don't have to remember any of that. What it's doing is it's showing, is there more buying or selling pressure at any moment in time and by how much? Your focus should be right here on this part in the middle. It's called a histogram. So you'll see a series of valleys and mountains. When you're in a valley, sellers are in control. In a mountain, buyers are in control. You'll also notice that the strength of the movement will change. So let's look at this right here. So we went from bullish to bearish, and then it got more bearish, more bearish, more bearish, more bearish, less bearish. It's still bearish, less bearish, less bearish, crossed over to bullish, more bullish, more bullish, less bullish. See what I'm doing? Okay. And you can actually draw trend lines on the histogram if you wanted to. So again, another potential point of exit. If I am in a bullish trade, like I own a call option, and the histogram turns red, might be a good signal to get out because that stock is no longer bullish. So there's all kind of points at which I could exit a trade if it's a bullish trade. Cross below the 50, cross below the lower trend line, or the MACD has turned red. See, this will keep you from taking 100% losses or giving your profits back. The toughest thing for most traders is knowing when to get out of a trade. Those of you who have done some options trading would probably go, yep, he's right. It's really not that difficult if you got something to look at. Most of you don't. The way that you do your analysis, and this is, again, just based on experience. Oh, yeah, that stock fell $5 a share. I should get out. Maybe you should, maybe you shouldn't. What are the rest of these things telling you? Is it still in an upward trend overall? Is the MACD still green? Are we still trading above the 50-day? That's the way that you make the decision. The RSI, the Relative Strength Index. Now, by the way, let me show you the MACD on the chart. So it's down here. So the idea is, I mean, if there's any validity to the MACD, when this is green, the stock ought to be going higher. When it's red, the stock should be going lower, right? So here it's green. Oh, look, stock going up. Oh, imagine that. Over here it's red. Oh, stock going down. Oh, wow, maybe this thing works. Then it turned green. Oh, stock went up. Then it turned red. Stock went down. How about that? My trading partner tells me all the time. She said, I could trade with nothing but a MACD. I'm like, yeah, that would make sense. You could. Let's look at a couple other stocks, see if it, I don't want to look like we just got lucky ones. So look at how strongly that MACD was, and look at that. Then what happened? Then it turned red right here. And that wouldn't have helped you a whole lot. I mean, you could have rode that up. You'd have made more money from here to here than you would have lost from there to there. But then it turned around and went back up again. And this whole period here, it was red. And then when did it turn green? Right here. By the way, when I see a MAC, and it really didn't pan out that much here, but when I get a cross above a moving average and the MACD is green, that's when I get very confident. So right here, that was at 157 and didn't go up a whole bunch in this case. How about on this one? MACD turned green right in here, and it crossed up above the 50 at 164. Now it's at 171. So now we're talking about putting things together, a combination of the MACD turns green and a cross above a 50-day. That's me putting on a bib and grabbing a knife and fork and just going to town. Let's look at a couple more. MACD turns green, crosses above the 50-day. Stock goes from 273, bounces off of support, goes to 371. There's Qualcomm. Well, I hope the MACD was red here. It was all the way back here. And it went from 212 all the way down to 159. What happened over here? Let me see. Oh, look. MACD turns green. At 165, crossed above the 50-day and goes all the way up to 227. See, now we're combining indicators. When people ask me, what's a great entry point? Well, there's lots of great entry points. One of which is MACD turns and we get a cross that agrees with the MACD, or the MACD turns red and then we get a cross below the moving average. What a great time to put on a bearish trade. Went from 209 down to 157. That's a 40% move, which would be a 400 to 800% move on the option. If you don't think this stuff is sexy, you don't know sexy. Here, we turn green, cross above the moving average, stock goes up, and then right here, it turns red and it plummets. And then it falls below while the MACD is red, falls below a moving average. There's a chance for a bearish trade. Where are we now on NVIDIA? Remember I said it's kind of just who knows? What does the MACD show? Just flat. The MACD is saying, who knows? Pretty fun. I love teaching this stuff. So the RSI, okay. The RSI is a short-term momentum indicator, and it is prone to ups and downs and quick moves. And I'll tell you what I use this for. It helps to identify stocks that are overbought or oversold. So in theory, based on historical pricing, it's saying this stock's too expensive. It's likely to come down from these prices. Or it's too cheap, it's likely to go up. Now, when I get that and a confirmation on the MACD together, generally that's pretty powerful. So here is the RSI. It will run in a range from 0 to 100. Below 30 is considered oversold and likely to go higher. And then above 70 is considered overbought and likely to come down. So I see, okay, what are we looking at? This was NVIDIA, overbought, and the MACD turned red. Did it come down from there? Well, it was at 126 and it came down to 98. Pick another one. Sometimes we don't have, so here, Verizon was over bought and the MACD turned red. Did it come down from there? A little bit. There's Qualcomm. Oh, look at this. It's saying overbought, overbought, overbought. MACD turns red. So a comment that I made earlier is that when you get good at technical analysis, it's almost like the chart is talking to you. It's like reading a book. It tells us what's happened. And then the tricky part is trying to figure out, like when we watch a movie, we're trying to figure out what's going to happen, right? And some are better than that at others. I'm good at it on a chart. I'm not great at it with movies, which is why movies are so much fun for me, because I never do know what's going to happen. And my memory is such that I can watch a movie, I can watch the same thing next year. I had no idea what happened the first time. All right, so that's the relative strength index. On balance volume. This is a really cool concept. Basically, what happens is it considers both the direction and the volume, which is really unusual. So if we have an up day on a stock, it takes the volume that day and it adds it. On a down day, it takes the volume and subtracts it. So let's say we have an up day with 1 million shares, a down day with 2 million, we're still at minus 1 million, which would be good because the higher the volume, the more weight we should give to the move, but it's hard to do that in an objective way. This does it for you. So let me show you what that looks like, and we'll add this ingredient. So I'm going to add down here to the bottom on balance volume. And how you would add it on your chart, it depends on your chart service. You're going to have to learn how to use that. So, and this one's a little harder to see, but right here, on balance volume was dropping while the MACD was dropping. And then it started moving up, just like the MACD was moving up. And look at the stock is moving up. It's one other confirmation. Here it says, hey, we are overpriced. The MACD turns red. We get a little dip here. And then look at how the volume is just falling off. And look what the stock was doing. So that proved itself on that one. How about on Verizon? Verizon's just, we should see it, OBV picking up here. Did it? Yes, look. So again, it's like, okay, MACD turns green, RSI's going up, OBV's going up, crossed above a moving average. Gee, maybe this stock's likely to go higher. Everything is giving us the same signal, which is ideal. And then Bollinger Bands, the idea behind Bollinger Bands, and here, let me throw a Bollinger Band on and I'll describe it. Some people are big fans of this. I've never found it to be particularly valuable, but maybe it's me. So a Bollinger Band is a price envelope. So you've got, these outside parts, and then somewhere tucked in here in the middle, it's kind of hard to see, is, let me try a different color for you. Something real bright. Yeah, how about white? What does that look like? Okay, there you go. That's easier to see. So this is a 20-day moving average, right? That line right here. Little dotted line. And these two outer bands are two standard deviations away from the 20-day. Okay. And the idea is, and people use Bollinger Bands in different ways. One way is to help identify potential breakout, and that would be when the two bands kind of pinch together. See how it was wider and then it gets narrower? Did it make a big move? Yeah. And the other is if the stock goes outside the band, then it will fight to come back to its mean, like it did here. Let's look at a couple of others. Okay, went outside, fought back in. Pinched together, big move. So there is some validity to it. I guess the biggest problem I've got is that Bollinger Bands just kind of